Alrighty. So in today's video, I'm going to be sharing with you a 90% win rate option strategy that has been doing pretty well for me. And this is one of my bread and butter strategies that I use this pretty often, right? So if you've been watching some of my other videos, you'll notice that I talk quite a bit about credit spreads, right? But for this strategy, it's going to have a few more steps to construct compared to the credit spreads, right? For credit spreads, is a two-legged strategy. For this strategy I'm about to share with you, it's going to have one additional leg. So it's going to be slightly more complex to construct, but I'm going to show you exactly how to construct it, because once you get a hang of it and you put on a few of these trades, then you're going to find that, it's going to be pretty simple and easy to construct later on. So what is this 90% win rate strategy? So there are a few of them. It depends on how you construct it. But for this one that I'm talking about in this video is none other than the broken wing butterfly. And for this video, I'm going to mainly focus on the put side, right? So this will be the put broken wing butterfly. And the main reason why I mainly focus on the put broken wing butterfly is because most of the underlying that I tend to trade on have put skew, right? In fact, most of the equities that you put on, they will have put skew. Unless you manage to find certain stocks that have call skew, then you want to put on the call broken wing butterfly, right? But for the most part, especially also with the index ETFs, you're going to have the put skew. So you want to use the put broken wing butterfly instead. So what exactly is the broken wing butterfly? Now, this is a slight variation to the butterfly, right? So if you have traded butterfly before, then you'll know that the P&L graph will look something like this, right? So basically your max profit zone is somewhere in the middle. So this is where you'll be making your profits. If the market stays within this two strikes down here, this is where you'll be placing your strikes, and then you have one right at the middle. This is where you have your max profit, right? So if you manage to pin your short strike right at the middle down here, then you're going to make the max profit. But if the market was to go much lower past this strike on your left hand side, this is where you're going to start to lose money. At the same time, if the market goes above this range down here, then this is where you're going to lose money as well. So this is the P&L graph, right? So anything above here is a profit. Anything below here will be in a loss, right? So as you can see down here, if the market travels past this point down here, you'll be having a loss at this point here. Anything that goes past here, you'll be a loss here. Okay, and if it stays somewhere in the middle, this is where your max profit zone is, right? Okay, so this is for the butterfly. So you notice that the butterfly has risk to both sides. For the butterfly, you mainly want the underlying to just stay in the middle, right? If it goes too far up or too far down, you will lose money. But for the broken wing butterfly, it's slightly different. We're going to adjust it so that there is actually no risk to one side, right? So in fact, there is no risk to the upside, right? That means the risk is only on one side, which is the downside. So if the stock or the underlying that you're trading just shoots all the way to the moon, you actually don't have to worry, right? Because you are still in a profit. So there's only risk to one side. So how do you actually construct the broken wing butterfly? So there are three legs that you have to construct, right? So the very first leg is a long put, right? So this is going to be out of the money. So as you can see on the chart on the right hand side down here, this is where the current price is, right? So anything that is out of the money is below the current market price. So as you can see down here, this is where the long put is. This is out of the money. Now the next leg is where you're going to sell two options, right? You're going to put two short puts on that's going to be further out of the money, right? This is where your max profit is going to be, right? And then after that, you're going to put on one long put that is even further out of the money. And this is where you define your risk, right? This is where you cap your risk, which means to say that, the market, if it goes all the way past this level down here, let's say at this point around 165, you only can lose up to that point, right? That means if the stock goes to zero, guess what? Your loss has already been limited. You already know your loss up front, right? So this is actually pretty good for beginners if you're just starting out, because your loss has been kept, right? Because if you remove this, By the way, if you remove this put option down here, now this structure here becomes a put ratio spread. So a put ratio spread is an undefined risk strategy whereby, it can be pretty profitable, but depending on how you construct it, right? Because also one thing is you need to choose the right underlying. Now, if the underlying just keeps going all the way down to zero, then this construct down here, which is the put ratio spread, is going to keep losing money as the market goes down. But if you have this put broken wing butterfly down here, the market can go all the way down for all you care. You already got your max risk cap. You're not going to lose more than that, right? So that is why this long put down here is pretty important for you to define your risk. All right, so this is how you actually construct the put broken wing butterfly. Slightly more steps than the normal credit spreads that most people are used to. There are 3 legs, all right? So how does it look like on the P&L graph, right? So this is the P&L graph. So the first thing you will notice is that it has a very high win rate, right? Again, it depends on how you construct, and I'm going to show you later on exactly how to construct this so you can achieve, 90% odd kind of a win rate, right? So the first thing is that it has a pretty high win rate. Now, next, how do you construct this on a P&L graph? You can see it's the same, right? So this is where the current market price is. You want your long put, the first one that is going to be out of the money. Then 2 short puts going to be slightly further out of money. And then you have 1 long put that is much further out of the money to define where your max loss is. So if you can see on this graph down here, where you're going to profit is anywhere past this point down here, right? This is where your break-even point is, right? Anything above this break-even point, you're going to be in a profit. So that is the reason why, this has a very high win rate. Well, because, the market basically can go up, you're going to be profit. The market can also go down and it still can profit as well, right? As long as it does not go past this point, this break-even point down here, you're going to be still in a profit, right? So if you notice down here, there are actually 2 types of profit zone, right? The first profit zone is down here. Right, so this is where you get your minimum profit, right? Minimum profit is basically the credit which you receive for selling on this put broken wing butterfly. So this put broken wing butterfly is a credit kind of strategy. That means you're selling premium. You receive a premium for putting on this strategy, and this is where you get your minimum profits past this long put point down here, right? So if the market keeps going all the way to the moon, at least you still get something, right? Now the next profit zone is where I call the tent, right? I call this the tent. So this is where you have the opportunity to actually, get this max profit down here. Now, of course, most of the time you won't get it, but there will be certain times where you could hit it or very close to it, right? This is where you can get the max profit, if you will, right? So one thing good about this strategy, if you notice, is that you have an incentive for the market to go down in your mind, right? Most of the time when people put on any strategy, when they get into the stock market, a lot of people are afraid that the market goes down, right? Because generally, most people have the mindset that if you get into the stock market, the thing that helps you make money is if the stock goes up, right? But in this case, you do not really have to worry if the market goes down to a certain extent, right? Because first thing, if the market goes up, hey, you still make money, right? So again, this is where the current market price is. If the market goes up, hey, you at least make some money, right? You get the premium which you sold this whole option strategy for. Now, if the market goes down, guess what? You then have the opportunity to get, the price into this tent down here, where you have the opportunity to have the max profit, right? You can see that, there's an opportunity for you to make much more than the minimum credit for this trade. So that is why, you don't really have to worry. In fact, whenever I put on this strategy, a lot of time I find myself wanting the market to go down, because this is where you can actually have a chance to get this max profit. Now, of course, you do not want it to go so far down that, this is where you get into your loss zone. So this is the second part. Now, the second part is where your loss zone is. So as you can see, you do not immediately lose the max profit. As you can see, your losses, starts to gradually get bigger only as the market goes down, right? But then you have your max loss already kept at this point down here. So even though if the market goes all the way down, let's say for example from this current market price, it travels all the way down, then you don't have to be afraid, right? Because you already know what's this max loss going to be. All right, so this is how it looks like on the P&L graph. Now I want to give you also a visual on the chart because some people like to see the chart rather than a P&L graph. So as you can see down here, once you construct your put broken wing butterfly, your profit zone down here is pretty big, right? Again, down here, if you see this -2 put, this is where your max profit zone is. So if you can just envision this graph down here, let me just bring up to the graph again. So let me just remove this drawing. You can see the graph down here looks like this, right? There's this nice tent, and then it goes up, and then your P&L zone, the point where you go to 0, is below this line down here. So if we were to go to this chart down here, you notice how it looks like is actually like this, right? This is where you have your minimum profit. Then it starts to go up, right? This is where it starts to go up. Then after that, this is where it starts to go down. And then this is where you have your max loss, right? So you can see down here, this is roughly where your break-even point is. This is where your max profit zone is. So you can see if the market goes up down here, you're going to be a profit, but it's just going to be the minimum profit. It's only when the market goes past this long put strike down here, that's where you have a chance to get, slightly more profits depending on where it lands, right? So this is where your tent is from here to here. Then anything past that, this is where your loss zone is going to be. And I put the red color all the way up to here, right, is mainly because your loss is kept up to this point, right? So if it goes all the way past here, it's going to be a loss as well. But it's just that, your loss has already been kept. Your losses do not keep increasing as it goes down. Now, for some people, this may seem a little bit confusing, right? Basically, you have the one long put, you have two short puts, you have one long put. So the way that I like to, put it to people, how to construct a broken wing butterfly, especially those who are, very familiar with trading credit spreads, is that it's actually just a combination of a credit spread and a debit spread, right? Let me explain to you what it means, right? So instead of seeing it as, 3 legs, just see it as this, right? First off, you have the put credit spread, right? So the put credit spread is the one right at the bottom, right? So for those of you who have been trading, the credit spreads, this is your bull put spread. So you'll be basically putting on a put credit spread where you receive a credit. Now with that credit, what you're going to do is you're going to purchase a debit spread. So as you can see, the debit spread is on the right hand side, the credit spread is on the left hand side. So for the credit spread, you'll be receiving a credit. So let's say, for example, you receive roughly around, let's say $2, right? You receive $2 in terms of credit spread. Now with this $2, what you're going to do is you're going to purchase this debit spread down here. Now this put debit spread, let's say you can buy one for $1.50. So you receive $2 in terms of credit. You purchase this put debit spread for $1.50. What is your leftover? Your leftover will be a positive 50 cents, right? So now you have a positive 50 cents. This is how you get a minimum credit if the market just goes up, right? So this is how I would suggest that you actually look at the broken wing butterfly, because it's pretty simple, right? Use a put credit spread to finance a put debit spread. So if you were to combine these two together, this is how you get the broken wing butterfly. Now, for those of you who have a bigger account, right? Maybe you have 6 figures in account, then maybe you might want to consider putting on the undefined risk version, which is the put ratio spread. So this is the one that I talked about earlier, right? So there'll be, some people who have pretty big accounts, and you notice that, if you put on the put broken wing butterfly, it's not going to give you the kind of desired kind of structure that you want, right? Mainly because the put ratio spread, because you do not have this one extra long put down here, right? We don't have this. What's going to happen is that you're going to have more credit from this 2 put options that's going to help you craft a bigger tent. So generally with the put ratio spread, you can have a higher win rate as well, right? But for those of you, if you don't have that big of a capital, you have a smaller capital, then definitely go for the put broken wing butterfly. So this is just an option for those people, also maybe because you might want to use this if you're using it on some underlying that's very, very cheap, right? If you have some underlying that you trade on that is very, very small, let's say maybe like $10, $20, then maybe you could consider using the put ratio spread there, because it might make more sense to construct it there. All right. So as you can see, this is the P&L graph for the put ratio spread. You can see it's pretty much the same as the put broken wing butterfly, right? It's just the difference between each other is just this long put. So in this case, you notice you're missing this long put down here to define the risk. Next, and more importantly, why do you want to trade the broken wing butterfly? So I'm going to give you a few very good reasons why you want to trade this broken wing butterfly. Now, the very first reason is that it has a very high win rate, right? As you can see, this is a 90% win rate. And in my experience, I've actually been getting, slightly higher than 90%. So if you are the kind of person that like to win often, right, then you might want to consider this strategy as well. Now, next, this is an omnidirectional option strategy. That means it can profit in many directions, right? You have already seen in the P&L graph. So I'm just going to demonstrate to you here again, right? This is where the current price is. You notice that if the market goes up, you're still going to be profitable. If the market stays down here, doesn't really move, then you're still going to be in profit. Now, if the market goes down as well, as long as it doesn't go past, where the break-even point is, let's say it's somewhere down here, then from here to here, you're still going to make profit. In fact, you're going to make much more than if the market goes up, right? So you can see the market can go up, it can go sideways, it can go down to a certain extent, and you still can be profitable. So that is why, I really like this strategy a lot. Next, it can be a good semi-hedge to a long portfolio. So maybe you have, a portfolio whereby you have many long strategies, right? Be it like debit spreads that is bullish, or maybe you have leaps that is bullish as well, or maybe you put on the bull put spread that is bullish as well, or you have just long stock positions, right? In any case, in all those bullish strategies, having this can be a pretty good semi-hedge, because if the market goes up, first of all, you will make money on all the other bullish strategies. But if the market goes down, you will lose on them. But in this case, you actually have a chance to, try and pin this short strike down here to get, much more profit than this minimum profit if the market goes up, right? So in a sense, I call this a semi-hedge as well, because it's not going to fully, of course, cover the losses of your, other positions. But it's better than nothing, right? At least you're going to get something to kind of hedge your long portfolio as the market starts to go down. Next, and I think this is a very important point that many people kind of miss, is that it is very psychologically easy to put on, because you can potentially make more when the market declines, right? Like I mentioned earlier on, many people are afraid that the market goes down, right? Because when the market goes down, generally people think that they're going to lose money. But in this case, you actually want the market to go down, right? You want it to get into this 10 down here. This is where your max profit zone is. And if it does, you can actually make a pretty good profit. Now, next, it can also have a good risk to reward ratio for a premium selling strategy. Now, as you know, if you have been trading, these types of premium selling strategy, like the credit spreads or even the iron condor, you'll notice that the risk to reward ratio is generally not that favorable, right? Most of the time for this kind of strategies, you'll be risking, let's say, 3 just to make 1, or maybe risk 4 to make 1, right? That's the kind of typical risk to reward ratio you get in terms of premium selling strategy. But when it comes to this broken wing butterfly, you can actually construct one that is 1:1 or even close to it, right? And I'm going to show you how to do that later on. And it all really depends on how you construct, this broken wing butterfly. So basically, the risk to reward can be pretty good. Now, when I talk about risk to reward here, by the way, I'm talking about the max profit to the max loss. And finally, it's consistently profitable regardless of the market condition. By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. Right, the market can be bullish, can be sideways, can be even bearish as well, and especially, in 2022, the market was pretty bearish, right? The market went down, and this strategy actually did pretty well for me, right? So I've just pulled up the last 50 trades or so, right? In this case, 51 trades, the last sample size of 51 trades, and you notice that there are quite a number of winners, right? Out of 51 trades, you notice there are 49 winners and only 2 losers, right? You have a loss down here and then a loss down here as well. And overall, you can see it's winner, right? If you talk about the win rate, you can see it's 96%, although, it should be roughly around 90%. Right, so as you can see, it is a very, very high win rate strategy, and you get to win a lot of the time. But although one thing you have to understand is that most of the time you tend to win just the minimum credit, because if the market goes up, and also depending on when you put on this strategy, if the market goes up and it never comes down to the 10, then you're just going to make the minimum, right? Which is also fine as well, because it's definitely better than you lose money. All right, so the next thing I want you to see down here is the delta. So you notice down here I have a varying delta, right? You have 19 delta, you have 16 delta, and this is how you actually construct, right? How you actually get to 90% win rate, it really comes down to the delta. So I'm going to show you in the trading platform how to construct your broken wing butterfly so that you can get around 90% win rate. Okay, so we are in the Thinkorswim platform for the web version. All right, so the first thing you want to do is to open up your option chain, right? So for the option chain, you can see down here, what we're going to focus on is on the put side, right? So the put side is on the right hand side. So for you to construct a put broken wing butterfly that is 90% and above, what is very important is where the short strike delta is, right? So remember, we have the two short strikes that define where your max profit zone is. So this is where we want to decide what that delta is. So generally for you to go somewhere around 90% or close to 90%, you want that short strike delta to be around 16 to 20 deltas, right? So if you were to take a look at the this down here on this right hand side, this column, it says delta over here. This is where we are going to choose our short strike first, right? So we always start off by selecting the short strikes for our put broken wing butterfly. So in this case, we want to go somewhere for 16 to 20 delta. So as you can see, we got quite a number of choices, right? So for this, let's just go with, let's say, the 18 delta, right? Let's just choose one somewhere in the middle. So I'll go with this. So what I'll do is that I will first click on this to get my short strike. And what I'll do is I will adjust this to 2, right? So for the Thinkorswim web version, it's going to be a little bit more manual, right? If you have the desktop version, then you can just right click and then just, put on the butterfly and just adjust your strikes from there, right? But for this example, because I'm using the web version, you have to be a little bit more manual for this, right? So I'm going to change this to 2. Now, the next thing that you want to select will be the long put strike that actually protects this whole structure, right? Basically where you're defining your risk. And if you think about it, it's actually the long put for the put credit spread side. So remember, I talked about thinking of this broken wing butterfly as having a put credit spread that finances a put debit spread. So now we're trying to figure out what is the long put for the put credit spread side, right? So for this, you want to go all the way up. Let me just bring up my mouse down here. Yep. So you want to find one long put somewhere around here that is further away from where your short strike is. Now, how do you define what the long put is? Now, this all comes down to what your max risk on the trade is, right? So if your max risk is $500, then the first thing you want to do is start off where your long put is somewhere around 5 to 10 points away from where this current short put is. So for this case, let me just jump 10 points away, right? So 458, I'll just go to 448. And then I'm going to start constructing from there. Now, this is not going to be the final structure because it all really depends on where you can buy the other long put, which is the put debit spread. All right, so I'm just going to put it down here first. So the next thing I'm going to do is I'm going to adjust this part down here to 1 contract. Now I'm going to find the long put. So this is going to be the long put for your debit spread. So this is where you want to, play around with it a little bit, right? So there's a little bit of just changing the strikes back and forth to find the desired structure that you want. That is why I say at the start, it's going to be a little bit more complex, slightly more steps than putting on just a credit spread. So for this, let's just go for 5-point wide first and see what we get, right? So 5-point wide, or rather away from 458 is 463. Right, so down here you notice you have your put broken wing butterfly structure ready. Now the first thing you notice is that you have 19 cents in terms of credit, right? 19 cents is the mid price. So what you want to do is you want to see what is the max loss for this. So for this, you can see we want to take a look at the buying power effect. Now the buying power effect is around $500, which is exactly what we want, right? Because our max risk we have decided for the trade is going to be 500. So the buying power effect for a defined risk strategy is basically the same as your max loss, right? But if you have an undefined risk strategy, it's going to be different, right? So I'm not going to be touching on undefined risk strategy for this video. Let's talk about just the put broken wing butterfly. So basically your buying power effect is the same as your max loss. So if you see that 483 is your buying power effect, it just means your max loss is 483. So this is pretty good. Now, the next thing you want to take a look at is the credit. So for this, you have about $16 in terms of credit, which is actually okay, right? Not so bad. So right now, you have a decision to make, right? Do you want more credit and then have a slightly smaller tent, or do you want lesser credit and have a bigger tent, right? As you can see, this is going to be a little bit of a trade-off, right? It's not something where you can find the best structure for this. It all really depends on what you want. So if you are someone who likes it to be a bigger tent where you're afraid that the market drops down, or you're using it as a hedge for any long stocks that you have in your portfolio, then you might want to go for a bigger tent. So in this case, if I want to go for a bigger tent, what I'll do is I'll adjust my debit strike down here. So I may want to go for one strike away and see what I can get. So if you notice down here, I can actually get 40 cents credit even after commissions, which is actually pretty good, right? But what it also means is that if the market just shoots up from where I put on this structure, where I put on this put broker butterfly, I'm just only going to get 40 cents, right? Which is going to be a little bit, too little for me, right? So in this case, I may want to adjust. So the next thing you can adjust is you notice your buying power now has gone down, right? Previously, if you notice, it was around $480, but now it has dropped to $399. Now, why is this so? Why is it that when we adjust this strike down here, just one strike away, we have a slightly lower buying power effect, which means to say our max loss is lower? The reason is because the max profit of your tent has now increased, because you have now increased the debit spread, right? Your debit spread width is now wider. It's now 6 points wide, which means to say your max profit is higher, which takes away from the max loss which you initially had, right? So in this case down here, since we have 399 as our max loss, I want to adjust this a little bit, right? Because I still have room to add more risk to this. Remember, it's about $500 my risk. So what I'm going to do is I'm going to stretch this by one more strike as well. So if I stretch this by one more strike, now you notice I have $488 in terms of my buying power effect, which is my max loss, and my credit now jumps up to $6.40. So which is not so bad, right? So now I have $6 in terms of credit if the market goes up, but if the market comes down, then I have an opportunity for it to come into a tent, which is now slightly bigger. Now, how do you know what is your max profit? Well, it's actually pretty simple. All you have to do is just go to your P&L graph, right? If you were to go to your P&L graph, as you can see down here, it's at the bottom, you can see what is your max profit, right? If I was to just hover this, by the way, I want you to take a look at this number down here, as it says P&L on the March 1st. This is at expiration, right? So at expiration, this is what your max profit will be. So if I bring it all the way to the height of this tent, as you can see, it says the max profit is somewhere around $543. Right? And what about your max loss? Your max loss is about $491. So as you can see down here, your max loss to your max profit, the risk to reward ratio is slightly better than 1:1, right? Because you now make slightly more, right? About $540 compared to your max loss of $490. So in terms of risk reward ratio, it's actually pretty good, right? So if you can somehow pin the max profit, if you're fortunate enough to pin the max profit, then even if you have one max loss later on, it's not going to wipe out the profit, right? But of course, most of the time, you're not going to hit this max profit down here. All right, so this is how you put on the put brokering butterfly, this 90% win rate strategy. And I hope you like this. If you did, I really appreciate if you would give me a thumbs up on this video. By the way, if you like this video, then you're absolutely going to love this next video, which I have for you. So go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen, and you'll be able to get it for free. Alright, I will see you in the next video.